Hey guys, we are back with the Holy Macro Show, and Kashop is with me today, as always, and we've got a lot of stuff to talk to you guys about. Mainly, what's on my mind is looking at global bonds. And this is something I talked about a little bit yesterday, but I wanted to bring up with Kashop specifically because I'm sure he has some thoughts on this because he's one of the other people in the world that I can talk to about these things. Most of the time, if I start to bring up something about UK bond yields, nobody cares, or they say that's not important, or something like that. And I know Kashop's paying attention to all this. I can even remember a conversation we had in what was that 2018 where I was buying the JGBs and you were like, I don't think I've ever heard of anybody buying JGBs, so we've been talking bonds for many years. And so, have you been paying attention to this story, looking around the world at all these bond yields? I know we talked about Japan. I know you're like very in depth in understanding Japan. So we could talk about Japan, the UK, whatever you're paying attention to here, because there's a lot going on in this chart.
So, like when you just mentioned JGBs in 2018, I remember this guy. His name was Trey Nippa. So back then I was at the Dollar Vigilante. He did a big presentation as to why you have to be short Japanese bonds. I think his website was called Short Japanese Government Bonds. And he got a lot of, I don't know if he got a lot of money, but he got some money from our subscribers to do that trade. And I don't know if it's exactly related, but he got into some fraud allegations with the SEC. And, like we talk about how Japanese bonds are the widowmaker trade in terms of price action, but, some of the characters in that market also, you never know if that's the actual widowmaker trade in terms of, the people who get involved in the short JGB side. Now, I mean, that's just me being silly, but more to your point, whether you look at UK or Japan, the reason people don't pay attention is because, I mean, almost nobody writes about it. But actually speaking, these are the markets that you should really, really pay attention to, because you see the US moving one way and you see all the other world bond markets moving the same way, then it's fine. Like the Fed is printing, the Bank of Japan is printing, the every other central bank is printing, and we just have an inflation party. That's fine. But what if you have a circumstance where the Fed is printing and the others are not printing, or all the other banks are printing, all the other central banks are printing, and the Fed is tightening? Now you get into these interesting divergences. So I know you're a fan of Ray Dalio. One of his books, he talks about how he talks about a trade where he's like, today the S&P 500 moved to 2.5% or something. Now, in that situation, how do I call what happens to my portfolio? And he says, I have a spread trade on, I think it was Dutch and German or Irish and German bonds or something. And he's like, how do I know what the correlation between the S&P and this trade will be? I don't know. And those are the kind of things that some of the biggest hedge funds in the world, the quants, actually worry about. So if you're not paying attention to these markets, chances are they are, and they know something, and there is some information in those price signals. So whether you take it by looking at the chart, whether you're taking it by talking to other traders, or whether you just follow what happens in the bond market and use that to kind of figure out where you should be positioned. So as macro traders, that's what we do best. So we see Japan. So when we see the yen strengthening, which is goes from say 160 to 140 to the dollar, so that's the yen strengthening. It's the inverse. So when we see the yen strengthening, it literally means run for the hills. When we see the yen weakening, it means hey, there's QE. Now everyone thinks QE is just the Fed printing money, but Bank of Japan prints much more money than the Fed, and they've been doing it for much longer. So they are kind of the central bank which drives the world. So you look at the Japanese money printing, then you look at how they are performing yield curve control. So you look at all of that, and you kind of know what is going to happen in New York. Now it's the same with the European Central Bank and the Bank of England, though to a slightly smaller extent. So in that case, it's mostly if you have a crisis in Europe, it's going to hit the US a little bit, but if they are printing, all that really does is it's risk on for US equities. So from 2014 onwards, we have been talking about this. So from 2014 onwards, the reason US outperformed Europe to such a huge extent is because all the European capital just came to the US, and that was a function of them keeping their interest rates at negative rates. And we went into the whole negative yielding bond, I think, in the previous episode. So if you want to catch up on that, you should catch up on that. So now, looking at this chart in front of me, looking at how yields are today, it's a clear signal that the market does not believe the Fed or other central banks are going to do some kind of operation twist or yield curve control. Because if you believe that, then you wouldn't see yields like this. Now, Bank of America came out and said today that they expect more Fed QE and more direct intervention on the long end of the curve. And maybe they have a reason for the speculation. And I would be very surprised if it happens. But then in today's market, nothing surprises me. So Intel is now a state-owned enterprise with the US government taking a 10% stake. Who would have had that on their bingo card a month ago? Right? It's just, these things are just completely crazy. I mean, like before 2008, just go back to 2008. So before 2008, central banks did not, other than Japan, central banks did not buy corporate bonds. And in 2008, the Fed said, we are going to buy commercial mortgages. We are going to buy corporate bonds. We are going to buy whatever junk the market throws at us and give it a good bid because, hey, that's our job now. Just print money and buy whatever is the distress asset of the day. So you never know what the central banks are going to do. But looking at yields like this, man, it's scary. You see yields going up this much. And so the other day, I saw a news item which said mortgage rates hit their lowest level in 2025. Now, at, in 2025, like that's at the very end. So,
That's funny. I mean, yeah, we've been chopping around sideways for the whole year, so obviously a 1% move in mortgage rates can bring it to that level. That's hilarious. But that's where we're at, like it's they're trying to make as much news positive as they can right now. And like there's a lot of things that are like worrying out here. Now, I'm not saying like, hey, I'm going to go short the S&P 500, I'm going to go short the whole market. It's in an uptrend. But there's some things out there, like looking at bond yields, especially globally, that will put some major pressure on consumers, on the market, on anything that you're looking at right now. And I think if we just look at yields alone, this is just telling us that yields are going higher. Like, the Japan situation happened, and I remember writing about that probably a month or two ago now. You started seeing, I mean, it's the green line on this chart. But if you look at it alone, it's the biggest rate of change. It's the one that's just moving in a parabolic uptrend over the last couple years. I mean, it's pretty insane. But I remember writing about that and people going, well, Japan doesn't matter that much. And I'd be like, well, Japan matters for a lot of reasons. It's one of our biggest trade partners, blah, blah, blah. You go through the whole list and they're like, well, it's just Japan. And then you look at the whole curve and you're like, well, everything's elevated. Nothing has broken down to a point where I'd say, okay, well, yields are heading lower in this country. They're not obeying the Fed rate at all. They're not riding with the Fed rate, which is something that can happen. Like sometimes they diverge. And the reason that usually diverges is when the long end says the Fed is wrong. We don't need to lower rates here. So right now, the long end is diverging to the upside, whether it's in the UK, the US, wherever. Even in the US, no, we haven't hit a new high. We've sit around that 5% zone a couple times this week. But even without hitting a new high, we're still elevated. And if you just looked at these charts and you let's say we took the fact that these are bond yields out of it. We took the Fed out of it. We took everything out of it. We just looked at it like complete price action traders and nothing else. And let's say it's NVIDIA. Like everybody would say, this isn't an uptrend, keep buying this thing. It's never going to stop. There'd be all types of people saying things like that. But because they're bond yields, people are like, well, they have to come down. The Fed's going to do this, Operation Twist that. Like, it's not like they just do Operation Twist every time anything happens. Everybody just thinks that's going to happen all of a sudden out of nowhere. And yeah, it can happen. And yes, the government is buying bonds on the long end of the curve. And people always go, well, this is the thing I've heard all this year. If Donald Trump is doing it, we should do it. Donald Trump said to buy stocks in I think it was May, and it was a great time to buy stocks and so on. Number one, it's the structure of the market you're in. If the market is in an uptrend and there's these spike bottoms, you can get back into an uptrend pretty easily. That's number one. Number two is don't listen to anybody like on TV, anybody like that to figure out your market opinion. They do not care. Like I could point to probably 50 other instances where Donald Trump has said something and it's been completely wrong for your positioning in the market. So because he's saying I'm buying bonds and the government's buying bonds and all this stuff, do they have enough money to really hold up this humongous market? Like that's the thing that I keep coming back to. Like could they hold up this massive market? And let's say they do. Let's say they hold, just the 30-year yield in the United States under 5%. Let's say we can do that. That doesn't mean the rest of the world's going to follow that. That means that the rest of the world might go higher, and at some point we will break higher. Like you can't manipulate markets forever. This is a thing that it goes back to old school Charles Dow, all the way back in the early 1900s, saying like you can't manipulate the primary trend, and that's the truth. And it's not because people always think of market manipulation in a bunch of ways. Like, oh yeah, silver manipulator, this manipulated. There's a lot of things out there that happen like that. But I'm saying in the long run, if you're looking at monthly charts, you're looking at weekly charts, you're really trying to understand the primary trends of these charts. If it's moving up, it usually will continue to move up, even if somebody's trying to manipulate that market. Especially a market as big as this. This isn't like we're talking about like a penny stock or silver, and even in the 70s. Like this is the bond market in the United States. It's one of the largest markets in the world. Bond markets generally globally are always one of the biggest markets in the world. So I do think this is still heading higher. Like I'm really convinced that this is heading higher. I don't care if the Fed lowers rates. I don't think that's going to help this.
I think if the Fed lowers rates, you're going to see long bonds scream higher across the world, because then everyone knows that it's going to be a highly inflationary economy. And now, so the difference between now and 2008, or even go back to 2015, is that every single move made by every single Fed official is watched. And thanks to the crypto crowd, thanks to the gold bugs really getting out there, everyone now knows that QE is just money printing. And thanks to the COVID stimulus and everyone's understanding of how money printing drives all prices higher, it is going to be very difficult for any kind of central bank meddling to not cause inflation, because part of it is expectations, right? And everyone knows that the Fed is going to print at so today the jobs number came out weak, the market rallied. Why? Because weak data means the Fed will print, the Fed will cut rates, and that's going to be a big stimulus for the market. So it's not about what happens in the economy, it's about what happens to asset prices. And they go up forever because there's this constant expectation that they'll just keep printing money. Now it's the same with inflation, it's the same with price inflation. If you know that inflation is going to go higher forever, if you know that gold is going to be rising forever, silver is going to be rising forever, platinum, palladium, you name it, if you know that, then what are you going to do? You're just going to take that trade, you're just going to take the inflation trade. And that's where things get interesting, because the more everyone takes the inflation trade, the more that becomes a self-fulfilling prophecy. So instead of just people crowding into the max 7 because everyone else is crowding into the max 7, you're going to see people crowding fully into corn and lumber and all these other things. And for us, we are traders, it's a futures contract, we don't even have to care what the specifications of the contract are. You trade it, you make money, you take that into your bank, you're golden. But for the people who use it as raw materials, for them, it's inflationary. So when cocoa spikes 12x, it's a huge problem for the chocolate makers. When coffee prices spike, it's a problem for Starbucks. And lumber prices spike, it's a problem for whole home builders. So on and on, wherever you go, all these commodity price spikes, they directly get translated into price inflation in the real economy. And now you add the threat of tariffs, the perceived threat of tariffs, and all these other complications, you're just going to get more and more inflation. So whether the economy is weak or not doesn't matter. The Fed is printing, you're buying commodities. And because the Fed is printing and the economy is weak, it's just going to get further weaker because of inflationary pressures, which means you get stagflation. Now, you can ask Grok any other AI what stagflation means, and it'll tell you, oh, the 70s or maybe the late 60s. And everyone's going to be like, oh my God, I have to panic and I have to buy real assets then. So this cycle, it cannot stop. It cannot stop for the simple reason that the Fed cannot stop printing money. And why will they never stop printing money? Because the central bankers are afraid of deflation. In 2002, I think it was Ben Bernanke came out with a paper where he said, we will drop piles of paper money off helicopters in New York City if necessary, but we'll make sure deflation doesn't happen here. The paper title was making sure deflation, it doesn't happen here or something like that. So that's the thinking of the central bankers, avoid deflation at all costs. Even the so-called monetarists, the Chicago school, for the Great Depression was blamed on the Fed not printing enough money. They said, oh, if only the Fed hadn't been constrained by the gold standard, if only the Fed had printed money, we would not have had a Great Depression. Well, guess what? There are times where the Fed prints so much and all you have is stagflation. So that's what we are setting up for there now, because there's just no avoiding it. That's the prevailing school of thought, that it's better to give people stagflation than to give them a deflationary depression. So that's what's going to happen. And no matter how much operation twist or yield curve control you do, maybe a market like Japan, you can control it. Like they have done a great job of controlling yields in Japan for a whole decade, and at the expense of completely blowing up their currency, at the expense of making it a completely controlled bond market. There's no bidder other than the Bank of Japan, at the expense of making the entire equity market controlled by the Bank of Japan. So Bank of Japan, I think, is the only central bank in the world which puts in a bid for Japanese stocks every single day, because they buy the stock market directly. Now you have that, you are going to have a very, very warped economy. Now it's still a superpower, and that's because from 1960s to the 1990s, they grew a ton and they accumulated a lot of wealth, and they're kind of growing that wealth as well. But if you look at conditions in, say, a bigger economy attempting that, it's never worked out well. In fact, if the Japanese experiment were tried by, say, Brazil or Argentina or Germany or even the United States, I highly doubt it's going to work out well now.
Yeah, I just think it's, like you keep mentioning, which is the fact that when we get to that point where we're looking at all these hedge funds and we're going, okay, well, what are they seeing out there? What are the other governments seeing? Like, I think they're seeing the same thing we're seeing, which is like, it's kind of just like basic economics 101. If we're going to just have this market in this massive uptrend, we're going to have commodity inflation under the surface. We're not to mention Powell is also been saying the same thing we're saying the whole time, which is if they were to lower rates, inflation would come back. So he's been sitting on his hands this whole time, which is surprising to see from a Fed chairman. So like we're seeing the situation here, which is very obvious that nobody else wants to see. Like it's like nobody wants to see this. It's like if I talk to people and I'm like, yeah, they're gonna lower rates, they're like, yes, and then tech's gonna come back and this, and it's like, no, it's inflation's gonna get out of control. It's the same thing we said, like, when they started trying to do it last year, and then all of a sudden Powell stopped very quickly. Why did he stop so quickly? Because if they would have kept going, inflation would have gone insane very quickly. Not to mention, if you look at the money supply all over the world, this is something like a chart that I bring up for myself, like probably once a week, just to look at, just looking at the different M2 money supplies over and over again. You're seeing them all hitting new highs in the last few months, weeks, whatever. They're just continue to be in uptrends. That's something that's telling you there's more liquidity already in the system. So if there's more liquidity already in the system, and then the Fed's definitely, I mean, we're at what, it was 94% yesterday. We're going to definitely lower rates this month. I mean, it's just like you have the ingredients here for a commodity super cycle. Like we're already been in one. It started in 2020. It cooled off, which nothing goes in a straight up trend, especially commodities. They go sideways, they go dead for a while, and then they pick back up. Gold's been telling you it's back. Copper tried to tell you as well. And then you have the copper miners just ripping to new highs. I mean, like all these international miners, whether you look at BVN, Hudbay, they're at new highs. The US miners look great. COPEX, which is the global copper miners ETF, is hitting new 52-week highs. We're just seeing this scenario that we've been talking about for a while here. And I know everybody's asking about energy. You know, when's energy going to pick up? I don't know. I wish I did. It really looks like it's happening, though. And the reason why I'm saying that is if you look all over the globe and you look at some of these stocks in different areas, different places, whether it's Europe, Asia, South America, you're starting to see these energy stocks start to pick up a little bit. And that's something we haven't seen yet at all. Like we haven't seen any of these stocks making new highs. Now we're starting to. Canada has some that look really good as well. So we're seeing a lot of Canadian energy stocks. We're seeing a lot of European energy stocks start to hit new 52-week highs. That's very bullish for this sector. So I think that it's like if we're looking at under the surface, what's really happening is people are sniffing out the inflation. And people who already have been there, like Kashap and I, you know, and that we're not the only ones in the world who were like, okay, well, gold miners are going to start looking great. You know, we're not the only ones who thought that, obviously, because it's up. I looked the other day and I was floored. I was like, it's up 90%. GDX alone is up 90 something percent this year already. That's wild. And some of the names are up 200, 300, 400. I mean, like, you've got this crazy move happening in the gold mining sector, and people could possibly think at the same time that inflation isn't here. Like, that's something that would have been like if we were living and having this conversation, Kashop, and this was, you know, let's say in the 90s, like nobody in the world would have been like, yeah, you know, inflation isn't here. It's just gold going up. Like everybody would have been like, yeah, it's inflationary. Same thing in the, you know, even the 2000s. That conversation changed once we got into the 2010s and there was all the quantitative easing and everybody was like, oh, well, that's going to lead to commodity price inflation and so on. And we did see that right after 2009 for a little bit, I think until basically 2011, 2012. And then that changed, that shifted very quickly. But there was reasons for that. Money didn't go into the normal public society. Money didn't. Also, there was money went straight from the banks were incentivized to hold on to that money because they were paid on that money as well. So there was a bunch of reasons why it didn't just go in there, but it did go in other areas. It went into the stock market, it went into technology stocks, it went into the bond market in certain ways. Like the money was out there. It certainly went places. It just didn't go back into the commodities. And that's also part of the cycle. The cycle was dead at that point. Now the cycle's back. So I think people should just get ready for it. Like to me, it's just a prepare for it, get ready for it, continue to put on these positions as they come. If you're a fundamental trader and you're trying to find value in those sectors. If you're a technician, like look for these breakouts as they happen. For me, if we got XLE above 100, we got to close above 100. I'd be very long XLE at the moment. So, you know, all of these things are basically pointing to the same thing, which is be ready for cyclicals, be ready for commodity led sectors to go higher.
So ConocoPhillips is one of the biggest independent oil producers. They're just laying off 25% of their workforce. Now, that's a clear sign of distress in the US energy space. So now if you look at, like I said, some of the international stocks, they are moving, and we talked about a few of them in the last video as well. So some of them, yeah, they are moving. The Canadian stocks, they are moving, but the US, it's kind of been stuck. And a lot of reason for that is the policy uncertainty. Now, if producers think, okay, Trump wants lower oil prices and president can get whatever he wants kind of thinking, if that permeates, then you're not going to be spending on capex, because you're only going to spend on growth capex if you think oil prices will be at least higher or at least sustainable, and that environment isn't there. And then you have all this uncertainty about, say, the tariffs. So let's look at it from the drilling point of view. So the tariffs, lot of the stuff, lot of the steel, the equipment, it gets imported. Now, if you're going to do some kind of growth capex, let's say you're budgeted 100 million in capex, and the tariffs hit, and your 100 million budget becomes 150 million. Now, you have a project with a 15% IRR, let's say the IRR goes to zero now. So what do? You just kind of put it off until this tariff messes behind you, which is what is happening. And we don't see it because we're not close to the industry, but I'm pretty sure if you talk to the people in the industry, they'll tell you that the tariffs and whether the fact that you're going to get your licenses or not, like the Trump administration says, yes, drill baby drill, but in reality, is that happening? So for instance, with copper, I know for a fact it's not happening. So the Resolution Copper project in Arizona, it was supposed to be a simple land swap, which would give them access to the property package that they need to build the mine, and it hasn't happened. So we had all these news releases about Fast 41 permitting and all that, but in the ground, it's not happening. So until it happens, we are not going to get higher production. And it's great to look at it on the news flow side and say, yes, Trump is very, pro this industry and pro that industry, and he's going to cut red tape and all that. But you have to look at it from the industry angle. And from the industry angle, it's not happening, or it's not happening as fast as the market expects it to happen. So I think that's the other reason. Maybe if you are looking at energy, I hope other ETFs come about, which have a more international exposure, something which splits between, say, the independent oil companies and the national oil companies. So, whichever way you want to go, you can build your own basket. So I think those will be the interesting products to look at rather than just the Spider Energy ETF. But of course, the rising tide lifts all boats. And if it's time for energy, then I'm pretty sure XLE is going to move as well. And I think best part for you, Jason, you have direct futures on XLE, so you don't have to bother with the ETF, right?
Yeah, so that's awesome. I wish there was single stock futures still, but there just isn't anymore. But this is something that I think could continue and probably head up higher going forward. But I like the idea of the international stocks at the moment. I think that's really where you want to be in this space. So next here we got gold up 8 months in a row. I wrote Sam the other day and I said, sorry about the dogs. They're just part of the brand at this point. But
I miss the cats.
Yeah, the cats they don't come down to the studio much. But when we're looking at this, I had to ask Sam. I was like, hey, how many months has gold been up in a row? And he's like, God, dude, you're getting old. And I was like, what do you mean? He's like, it says right there. And I was like, oh, it's 8 months. It's like, so 8 months in a row, gold has been up 8 months in a row. Feeder cattle's been up 12 months in a row. So do you have any thoughts on, how high this thing can go? Do you think we're anywhere near the end of the precious metals bull market?
So I made a post about a couple of months ago. Let me see if I can find it. So I talk about this is Egyptian billionaire, the Sawiris family. I think it was 2018. He made a post saying that gold is going to 1800 an ounce, and he's going to put like 25-30% of his net worth in gold because of that. And his price target got exceeded and exceeded, and now we are like a double his price target. So that's the reason I'm very skeptical about putting out how high can this go. I think there is no limit to how high this can go. Is there a limit to the prices? Is there a limit to the price of land in a growing urban area? There really isn't. So the childhood home that I grew up in, I can't even tell you the percentage move that the land value has appreciated, and that's just because of the currency. And you go back to, so here's the funny thing is, like, I've been looking at Turkish equities recently, and in Turkey there is a accounting rule which says once the currency has hyperinflated, you have to restate all your historic cost basis to make it understandable for the current audience. Meaning, you bought something at 100 TRY or something, whatever, and now that 100 TRY is worth 1500, you need to restate it, because you stating it at 100 is not going to help investors. And I think the denominator, whether it's the dollar or, I mean, it's not the Turkish lira, so dollar, pounds, everything is getting debased at such a rapid pace, and everyone is now aware of it. So there was a point where only the finance folk were aware of it. There was a point where only the gold bugs were aware of it. There was a point where only the Bitcoiners were aware of it. But now everyone knows it. And when everyone knows it, and when everyone is seeing these moves, and all they have to do is go on to Robinhood, or now you have tokenized equities, tokenized gold. You have all these options. Just go click a button, take your savings, take it out of the dollar, take it out of fiat, put it into gold. When this mentality comes in and people start saving in gold again, how high can this really go? Well, it depends on whether or not the central banks stabilize their fiat currencies, and that's not happening. And if you also look at, so I saw an interesting chart the other day where someone, I think it was Tavi Costa, I'm not sure, said that central banks now hold more reserves in gold than in treasuries. That's a first. That's a first since Bretton Woods. Now, is this the kind of statistic you would see at the start of the move or at the end of a move? I think it's at the start of a move. I think this is a trend where people are looking at their over exposure to US assets and saying, maybe US is not the best place to be. Maybe there are other markets that we should look at. Now, the parallel for this is if you go back to the 2000s, the US did very well. 2002 to 2007, US had a booming economy. But where was the money made? The money was made in India, China, South Africa, Brazil, pretty much any other country you can name, Eastern Europe, anywhere and everywhere. So the bigger money was made in all these other markets. And that's how it's going to whether or not you should hold your capital in US treasuries or maybe switch to something else. The something else earlier, it used to be the Deutschmark and the Swiss franc. Now, those aren't really options anymore. Sure, you can buy Swiss francs. I own Swiss francs as an alternative to the dollar. But what else can you own? And the answer is gold. Like some people would say yes, it's Bitcoin, but Bitcoin right now is going through its own crisis. So there's an internal power struggle going on between two camps about how they want to run the next version of the software. So while that uncertainty is going on, you don't want to touch Bitcoin. So what do? Gold is simple. There is no developers who can control gold. There is no big mining cartel which can control gold. There is no gold pool like the 60s London gold pool which can try to control gold. And even if they did, they would all fail because everyone understands gold. The entire world understands gold. So I wouldn't put a price target on it. Goes to $10,000, fine. Goes to $20,000, fine. Doesn't matter. You have to just look at what is the currency buying you at that time. You have to look at it in terms of ratios. Look at the gold to oil ratio. Look at the gold to Dow ratio. So look at those ratios, and that will tell you whether it's time to be in gold or time to be in the Dow or time to be in, say, oil or other things. So I would just use ratio charts exclusively and not look to time gold in terms of dollars or other fiat.
Yeah, I think Sam's had a target of like 8,000, and like you and I are similar in the sense, like I don't know how high something can go. I don't know how low something can go. I like the idea of just looking at the ratio charts, just understanding where you want to be in your own time frame. Like that also matters. Like for myself or even Kashop, like we could be in some of these trades for a long time. It could be years. But for some people, they might be looking at it in a more short-term sense. So make sure you're fixing these trades for your own time frame. But I definitely like the idea here of just looking at gold and understanding like it's in a raging bull market. If we look under the surface at, I think I actually brought a chart of this, which is GDXJ. We're like we were talking about just a minute ago, which is these miners are up over 90% this year already. And I think a lot of people would look at that and go, oh, I don't want to be in these now. They've already made their move and so on. Really look at the things that have moved 100%. Like big moves lead to big moves. So like sometimes things start out in a big way. But if you really look at this chart, I remember pointing to that right when it was breaking out, just above this blue line here We saw this breakout. And I'd say, yeah, I think this thing's just getting started. And people would go, oh my God, the move's been huge. We've had this huge move already here. How's this going to continue? And it just keeps continuing. And it's because when money goes into a sector, it's just all based on relative strength. It's the reason why we use ratio charts and look at things like that. Where money is flowing, it usually continues to flow. It's just like a couple things to just understand. If you see relative strength in a sector, you want to be in that sector. If you want to see if you see a stock or ETF or future in an uptrend, you want to stay in that uptrend. That's the simplest way to make money in these markets. And I think GDXJ is just telling you the same thing. And if you look under the surface at the individual names, like they're even stronger. So I think there's so much value in this sector still. And I keep having people go, now that you're talking about energy again, you're going to sell all your gold miners and go to energy. Now, number one, not the way I trade. The way I trade is if something is in an uptrend, I'm probably going to be in it until it's not in an uptrend. I could completely hate the trade. There's times where I've been in technology and been like, wow, this is pretty insane. Why am I still in this trade? But at the same time, it's in an uptrend. So I'm not going to get out of that trade. It's the same thing here. Like I'm just going to hang out in this trade. If the energy stocks start to really break out and I'm going to full positions across the board and all of these things, sure, I'm going to get in those too, but I'm not going to sell this trade. I will still be in GDXJ. I'll still be in GDX. I'll still be in gold, silver, platinum, and I'll still be making money in those because until they break trend, I think that's a really important way to trade. And so, Kashop, I wanted to talk about these intermarket relationships with you. We're looking at this one. So this is gold, which is the gold line, and then TLT, Treasury Bond ETF, which is the green line. So when we're looking at these two, we're seeing that they move together for a long period of time, and now they're not moving together. Now, so many people have talked to me lately and gone, wow, the bonds need to go up. Why? Well, gold's going up. So I explained this yesterday, but I just want you to explain it to the people. Like, why did this relationship shift and change? And what's the normal relationship for gold and bonds?
So if you go back to the previous decade, so this is after the Fed starts QE and after the PIGS crisis is played out and sort of things start to normalize, what you see is that it was a low yielding environment in the sense that uh, the bond market was pretty stable. So you had stable yields, but you had low yields. So the trade was stick to safety, just buy the bonds and maybe make 2% a year, go a little higher yield and buy, say, utilities, staples, the dividend aristocrats, things like that, maybe get a higher yield, or buy gold because in the long term, the price appreciation in gold will be equivalent to whatever yield you would get by owning bonds. And it gives you a nice currency hedge. So these were the options for a fixed income investor. And they took the gold trade and they also took the bond trade, the staples, all the other things. So they took the MLP trade, which is something which hasn't come back since that time. So in that environment, you would see gold, bonds, anything which is valued for its dividend or its yield go up together. But the environment has now changed. Now we have an environment where the expectation is the Fed will keep printing money, that money will rapidly lose its value, and inflation is a risk. And if you're buying 20, 30-year bonds, chances are, when you get your capital back, it's going to be like the Home Alone scene where, $20 worth of groceries back then was like this huge shopping trolley. And now, you probably carry it in your hand and walk out of the supermarket. So the value of your money, if you're buying bonds, it's not going to hold up. Whereas a gold bar, it's going to hold up. Now there's this company which puts out these reports in terms of gold priced in beer at Oktoberfest. It's called Incrementum Research. So you can go look at their chart. They are pretty hilarious to look at, but they also tell a good lesson, which is that over very long periods of time, whether it's an inflationary situation or a deflationary situation, gold tends to hold its value pretty well over the long term. And the same cannot be said for bonds or for any fixed income instrument. So if you go back in time, there was this time where Britain was the world's strongest empire before the US took over. And they had these bonds called consols, which were perpetual bonds. So they just paid you a yield and there was no maturity. And in the 70s, within like 2, 3 years, those bonds lost 75, 80% of their value. They were just gone. And if you held them, you got annihilated. If you held gold, you did fine. So this is the kind of environment that we are heading into now. Not that treasuries are going to be annihilated at some point. May happen, may not happen. But the point is the risks are now rising. So when you see those risks rising, you are better off owning gold as compared to owning treasuries. Now, I personally cannot see any situation in which you want to own something which is over 2 years in maturity, because in 2 years, sure, you're kind of protected and there's plenty of liquidity. You go longer term, there are absolutely no guarantees. So the 20, 30-year bonds, it's a huge risk in terms of what the Fed will do, what will happen to the currency, what will happen to yields, everything, what will happen with inflation. So the easiest trade, the simplest trade is gold. And I think people are kind of catching on to it.
Yeah, I think it's right on point, which is the idea here of safe havens is what we're really talking about. Like, are bonds really a safe haven? Like, it depends on the environment. Like, if you're in an environment where they are, yes, go back to the last 40 years before 2020. Sure, you could say that. In an environment like we're in today, absolutely not. It is not a safe haven asset. Sure, like Kashop said, you want to be in the short end, but as a normal trader, you buying the SHI ETF or something like that, like you're gonna make like $1 and be very upset that you even bought the thing. It's nice to put your money in that if you're just trying to make a yield or someplace instead of just holding it in cash, fine. But if you're really looking to trade it, you have to be in the futures market. And you can make a lot of money in those. Like bonds on the short end are great. You can get a lot of leverage. You can trade them. They're great. They're very liquid. But if you're trading them in the ETF market, it's just not going to be the same bang for your buck. Um, I have to leave a little bit early today, Kashop. So we're going to end on that. Do you have anything else you want to end on? I got a couple minutes.
I can't think of anything. I think it's perfect that we're talking about bonds and gold, because this is really the relationship. Like gold, like everyone talks about gold, oh, like it's a momentum asset, it's this, it's that, but end of the day, it's a very, very prudent investment. It's like owning your own house. So owning your own house is not going to give you the greatest financial reward unless you bought it right before people came into your town and now the neighborhood's gentrified. But owning your house gives you that feeling of security which nothing else gives you. And it's the same with owning gold. You own physical gold, you own gold with great counterparties, whichever way you own it, it gives you that sense of peace, that sense of comfort, knowing no matter what happens, you have a safe haven. Market tanks, doesn't matter. Hyperinflation doesn't matter. Any kind of scenario doesn't matter. Give it 20, 30 years and you will definitely be better off for it. So if you look at gold versus the S&P with dividends reinvested and adding to your position every year, gold has actually outperformed the S&P in the last 25 years. Now, what is Vanguard going to say for that? They have no answer, because their product sucks. That's the
Yep.
truth. And it comes with too much volatility, whereas gold really doesn't have. So the worst drawdown in gold was in terms of time rather than price. So 1900 to something like $1,100. That's it. That was a single biggest drawdown. And then during the 2008 crashed, it fell a little, but in the broad scheme of things, those were like very, very minor. So the biggest corrections in gold, if it happens, it's in terms of time. And that just means that you get to keep adding throughout your working life. So, which is what makes it a very conservative and safe investment. So, I think that's what you should focus on. Like, if you're the kind of person who buys bonds for safety, buy gold instead.
No, I like it. Let's end on that. All right, guys, we'll be back with you with the Holy Macro Show next week on Friday at 10 a.m. Eastern Time. We'll see you then.
Bye, everyone.